Is a quality of earnings report worth it? You might be thinking, hey, these things are expensive. It's going to cost me $8, $10, $11, $20,000. What's going on here? Is this worth it? I already understand the financials. I'm going to explain why it is and why it's critical that you get one on almost any deal in this video. My name is Zachary Jensen. I'm the managing partner here at TaxWise, where we're empowering small business owners with tax strategies so they can build more wealth. Today in this video, I wanted to go over the importance of quality of earnings reports and why you need one if you're going to be buying a business, no matter what the size is. So yes, it is worth it to answer the question in a sentence, but let's go over exactly why. So in the complex landscape of mergers and acquisitions and M&A, obtaining a quality of earnings report is a critical component of the due diligence process. And while audited financial statements provide a snapshot of the company's financial position itself, they do not reveal the full picture of its earnings, the quality of those earnings, and the sustainability of the sources of those earnings. And a QOE dives into all of that. It also offers insights that are essential to making more informed decisions once you actually own the business. So let's understand what a quality of earnings report actually is. So quality of earnings report is a comprehensive analysis that evaluates the sustainability and accuracy of a company's earnings. Unlike standard audits, which focus on compliance with accounting standards, a QOE report examines the underlying factors contributing to the reported earnings. This includes identifying non-recurring revenues and expenses, assessing revenue recognition practices, and evaluating the quality of the assets and liabilities underlying the business itself. The goal here is to present a clear picture of the company's true earning potential, free from the distortions caused by one-time events or aggressive accounting practices. Now, you may be wondering, Zach, I already have the audited financial statements. I'm good to go. But there are limits to these audited financial statements. Audited financial statements are designed to ensure that a company's financial records adhere to generally accepted accounting principles, or GAAP, or International Financial Reporting Standards, IFRS for short, while they provide assurance that the financial statements are free from material misstatement. They do not necessarily assess the quality or sustainability of the earnings themselves. For instance, an audit may confirm that revenue has been recognized in accordance with accounting standards, but it won't evaluate whether the revenue is likely to reoccur in the future. And this distinction is critical for buyers in an M&A context, especially for small business buyers where there is a lot of either key man risk, key customer concentration risk, et cetera, as it directly impacts the valuation of the business and the future performance of the target company. So I'm going to rattle off a few key benefits of the QOE report, right? You get accurate information, right? We adjust the earning for non-recurring items and normalize the financial metrics. So a QOE report ensures the company's valuation reflects the true earning capacity. So that SDE you're looking at, we got to make sure that it's legit for you moving forward. We also identify risks, right? So a QOE analysis uncovers potential financial red flags, such as inconsistent revenue recognition, unsustainable profit margins, or hidden liabilities or understated liabilities. And identifying these issues obviously help you make better decisions as the business owner moving forward. It also gives you more negotiation leverage, right? You're towards the end of your deal, and armed with a QOE report, you can just show it to your seller, and buyers are in a better position to negotiate favorable deal terms on specific things that are uncovered in the QOE. And then, of course, the post-acquisition planning, right? We understand the quality and sustainability of the earnings, and we're able to make critical day one decisions on how to improve that quality of earnings or mitigate against any risks found in the report. So the QOE report is underscored by instances where relying solely on financial statements that were audited led to unforeseen challenges. For example, if a corporation reports large net income figures but negative operating cash flow, it may not be as financially sound as it appears, right? A quality of earnings report would assess how a company accumulates revenues itself, such as cash, non-cash, reoccurring, or non-reoccurring. And this provides a more accurate picture of financial health. So I hope you get a quality of earnings after watching this video, because you're going to need it no matter what deal you're buying. And of course, the smaller the deal is, the more risk there usually is. So definitely want to get this. So even if you have a small deal, get the quality of earnings. Here at TaxWise, we do offer quality of earnings reports for clients. We are by business buyers for business buyers. So unlike a lot of these other kind of stuffy CPA places, we have bought businesses and have helped hundreds of others buy businesses as well, from LOI all the way to closing. So we know this process like the back of our hand, and the quality of earnings report is just the cherry on top. We do extensive due diligence that other firms do not. So if you like that, if that sounds helpful to you, please reach out to us in the description below. Thanks so much for watching. Have a great day.